If you get a lump sum payout income tax free, keep it income tax free. In this episode, I'm going to address the question, what to do with a lump sum insurance payout. And when I tell you that, hey, the best thing that you can do is to keep it tax free, your next question is, what's tax free? How do I do that? I am going to share the steps in this episode. So when people ask that question, usually they're getting an insurance settlement. Most of the time, it's in the form of a death benefit, life insurance. And so they receive a life insurance death benefit proceed because their spouse passed away or their mother or father passed away and they were named the beneficiary of the insurance policy. Now, one of the benefits of life insurance is that when the person, the insured, dies, then the death benefit is paid out income tax free. It's a sacred cow in the Internal Revenue Code. This is provided under Section 101A of the Internal Revenue Code, even before the code, but the code came around in 1913. It's been this way for over a century because you're taking pressure off of the government to take care of widows and orphans, beneficiaries, from having to rely on the government. It actually saves the government money if they keep it tax free. Well, if you receive a settlement from an insurance company because of an accident or a liability, or you're settling a case, oftentimes that money is also income tax free. So if you're getting a lump sum, whether it's $100,000, $1 million, $10 million, $50 million, if it's tax free, why not keep it tax free? Now, when I tell that to people, they go, whoa, I've never thought of that. How do you do that? In fact, most CPAs and tax attorneys, I go, why would you ever advise a client to take a tax-free insurance payout and put it into a vehicle that they're going to have to pay taxes on from that day forward? Keep it tax-free. And they go, how do you do that? It's amazing what they don't know. So here's how you can keep it tax-free and put that money back into vehicles that will continue to grow tax-free. And I'm going to share with you how we do that in our own family in what I call our family bank that will go into perpetuity and keep it tax-free for generations. Now, first of all, I need to warn you because many widows who have received a lump sum insurance payout of $1 million, $5 million. I remember a mining disaster in Utah where there were like 220 widows that received lump sum benefits of anywhere from $250,000 up to $1 million, totally income tax free, when a mine collapsed and there were all these miners that died. And 5 years later, there was nothing to show for those millions of dollars because what did they do? They went out and they loaned it to their children. They went into a venture with a partner on a restaurant. I can tell you all kinds of horror stories. And sadly, a lot of times widows and widowers are given the wrong advice and they end up losing it. Let's say that you get a lump sum payout of $1 million. Now, that is generally income tax free. And so I go, hey, keep it tax free. Well, how do I do that? Well, would you consider that insurance to be a positive or a negative where you just got $1 million income tax free? Well, I've always thought insurance was a necessary evil, but I sort of like it right now. It protected me. It gave me $1 million and I don't have to pay tax on it. I go, so why don't you put it back into a portfolio of insurance contracts? Well, can I take income? And I go, hello? Absolutely. But see, most people don't know how to do this. See, people come to me and they want living benefits. And so what they do is they take out insurance policies or insurance contracts for the living benefit. This wasn't my idea. This was E.F. Hutton's idea clear back in 1980. And so Universal Life was born and it was designed to be used for living tax-free growth and tax-free income. So you're doing the opposite. Instead of trying to get the most insurance protection as you can for the least premium, you're doing the opposite. You're taking the least amount of insurance the IRS will let you get away with, and you're putting in the most premium. So if you got $1 million tax-free, I mean, you can use some of it for something or another, but I would take the majority of that and I would put it back into another max-funded insurance contract, but I would take the least death benefit so that your money is growing at a net internal rate of return of 6 to 10%. That million should double every 7.5 to 10 years. So that $1 million goes to $2 million, and then to $4 million, and then to $8 million. And we have many, many clients who have experienced exactly that. And they funded it with tax-free proceeds from insurance payouts. So for example, in our family, every time the oldest person or person passes away, which is usually the older people, we take 20% of that tax-free death benefit and automatically we pay for another tax-free insurance policy. And normally that will fund a $2 million. If they took out $1 million and that's what they received at death, they take 20% of that or $200,000, and that can usually purchase $2 million of insurance on the next oldest healthy family member. And so every time as an older person dies in our family bank, this is where we accumulate money for all kinds of goals in our family, kids, grandkids, college, religious missions, military, the purchase of a first home. They borrow from the family bank, and they are able to do that tax-free out of their life insurance policies. But they do it by putting it in there. And every time somebody dies in our family, we sort of have a celebration. Now, we not only celebrate their life, but see, we get this tremendous infusion of tax-free capital, and it keeps just blossoming and growing. So we use it for tax-free capital into perpetuity. But if somebody came to me, a widow, and they had $1 million from their husband's life insurance proceeds, I've told many of them, hey, let's take out a policy for you and let's make room for $1 million to put into that. Now, they can't put it in all at once. It takes 5 years to fund it, $200,000 a year, to comply with a tax law called TAMRA. But in 5 years, or as little as 4 years in one day, their $1 million is into a new insurance company on their life, and that covers them for maybe $2.5 or $3 million, so that when they ultimately die, it blossoms. But what does it mean? It means their $1 million is generating an internal rate of return, tax-free, of 6 to 10%. They could pull out $60,000 to $100,000 a year of tax-free income without depleting principal. There's nowhere else they can do that. And so I say, let's keep it tax-free. Why would you take $1 million of tax-free payout and then put it into an investment that's going to be taxable? That's silly. Keep it tax-free. And they go, golly, I've never heard of this before. Well, it's because so many people aren't educated. They're so used to going to financial planners that say, oh, put your money in these mutual funds or in the stock market or do this or buy this real estate. And there might be some minor tax advantages, but it's not 100% tax-free like maximum funded insurance contracts are. So my recommendation would be this. Take whatever tax advantage insurance payout you get, use anything for maybe final expenses or whatever, but take the remainder and keep it tax-free so that you can take tax-free income for as long as you live. And when you ultimately die, whatever is in there will blossom, double, triple maybe, or even more, and transfer income tax-free to the next beneficiary so that the estate continues to grow. We will never in our family outlive our family growing in our posterity because of our family bank being funded by tax-free insurance. And every time somebody passes away, a portion of that goes into the next insurance contract, which keeps our family bank funded into perpetuity. So if you want to understand this better and read some stories about how this works, I would recommend reading my most recent book, The Laser Fund. It's actually 2 books in one. This is the left brain side, this is the right brain side. This side has about 200 pages with all kinds of charts and graphs and explanations. If you like the logic, the numbers, if you like to learn by stories, be sure and read the chapter in the right brain side. There's 12 chapters here about how to use this for all kinds of goals, from college funding, retirement, emergency funds. But for estate planning in our family bank, you'll read stories in here about how this works from one generation to the next by taking tax-free insurance payouts and keeping that money tax-free forever. The book retails for $20, but I want to gift you a copy absolutely free. So to claim your free copy, simply go to laserfund.com, contribute $5.95 towards the shipping and handling. It's a little bit more than that, but if you'll do that, I'll pay for the book and send it out to you absolutely free. Or you can also watch this next episode and learn a little bit more about how you can accumulate, access, and transfer your money totally tax-free.